Now let's move on to part 2 of chapter 4. So in part 1, we talked about the audit risk model. Now we're moving on to talk about the risk assessment process at the entity engagement level. So how does this relate to the audit risk model? Well, it's actually starting off at a slightly higher level because we want to understand the entity's business risks, then think about how those risks can go wrong at an account level, and then we'll use these risks we identified to help us assess RMM and also help us assess engagement risk if there's anything relevant there, which will help us determine our audit risk. For example, we would want to understand what business risks are associated with this particular engagement. For example, let's say the business risk of a company is they're selling goods to a declining customer base. So think about a business like the DVD/Blu-ray business, right? Clearly declining customer base, mostly going to be older individuals who haven't fully embraced digital technology, but definitely not, if anything, sales are declining, they're not growing in this industry. So we would take a risk like that, which is a high-level business risk, and then we would want to think about, okay, how does this risk affect me down at the account level? Which accounts are most likely to be misstated because of this risk? Which disclosures are most likely to be misstated due to this risk? So with respect to the declining customer base, you could say, all right, so maybe now they want to overstate income. They want to overstate accounts receivable. So now I know when I'm looking at accounts receivable, I need to some of these risks, like the risk that they may have fake customers in AR, the risk that they may have overstated AR. Those risks might be heightened because they are selling to a declining customer base. And this slide just gives a big picture overview of the risk assessment process. So it talks about different strategies we'll use. So we'll do inquiry, we'll do analytical procedures, we may do observations, and then different areas that we'd want to understand or look at. So things like the nature of the business, industry factors, external factors, regulation, stuff like the environmental laws. If it's relevant to our clients, we want to understand their various objectives going forward, any business risks. Want to think about entity performance measures, what benchmarks are relevant to our particular client, and we want to understand efficacy of internal controls. So if we understand all this stuff, this is going to help us identify any engagement risks we're exposed to, what inherent risks we're exposed to, and it will help us figure out what our assessment of control risk is. So the point of all these procedures that we're going to talk through is really to help us nail down what is engagement risk, what is inherent risk, and what is control risk, because those are the ones we have to measure, and then accordingly we will set our audit risk and detection risk as a result. So there are various types of risk assessment procedures we can do. One is inquiry, and you could talk to lots of different people, right? The most common ones are ones like those charged with governance, so board of directors, the C-suite, the audit committee. Also talking to internal audit, the internal audit department can be really helpful, in-house legal counsel, and talking to the little people or blue collar workers can be really helpful. So it talks about how we do inquiry, analytical procedures, and observation and inspection. So one thing we might do is when we're doing, for example, our inventory observations, we go out to the actual warehouses and distribution centers of the client. And there we're really able to talk to employees on the ground floor of the business, if you will, that are doing like the shipping, they're doing the receiving, they're doing the inventory management, and they should have a really good idea of what's going on in terms of stuff like, hey, how's inventory moving? What parts of inventory aren't moving? Okay, so maybe we need to have inventory write-downs because inventory is not valued correctly. Nobody wants to buy this, right? And that could be another risk that we'd observed at the kind of business level, because if you observe you're in a declining customer base like our DVD business, then maybe my inventory is going to have to be sold off at a discount because nobody wants it. And so when I'm in my warehouses and distribution centers doing my inventory observations, I can then talk to the workers and say, hey, are there particular product lines that are just not doing quite as well as others? Is there a section of the warehouse devoted to inventory that nobody buys? So it's in like the back corner because nobody ever has to go there to pull products because nobody wants these products. Right? Versus a kind of more high volume section of the warehouse where that's where we ship most of our inventory out of. So you can talk to them and they'll be able to give you an idea about that. And then you can be like, oh, okay, so we want to make sure inventory valuation is correct, that it is valued at lower of cost or market, because a lot of these things, if you have a declining customer base, you're not going to be able to sell it at cost. You might have to sell it at a discount, and market value is actually lower than cost. And that's when that could become a real risk. And you need to set some sort of contra asset inventory obsolescence reserve to make sure you haven't overvalued your inventory. You can also talk to people outside the entity. So this could be a good way to detect fraud if the company is telling you that they made a large sale, but none of their customers have heard about it. Analytical procedures are also great to help us identify risks. And there's lots of different types of analytical procedures. So let's talk through a few of those. One type of analytical procedure would be year-over-year fluctuation or flux comparisons. So this is when I literally just take last year versus this year's balances, and I compare the dollar value of the change and the percent change. Now, usually I'll set some materiality threshold. So for instance, I'll say, I'm only going to look at changes greater than TM and 10%, right? And so in this case, if our TM were $1 million, I'd only be looking at this change. It's over both TM and 10%. I'd be looking at this change. I'd be looking at this change. Right? You could the reason why it's TM and 10% is you could have a really large account where it's moving by several $1 million, but in the grand scheme of things, it's only moved like 1% of its value. That we would not consider a big change. And part of the reason why is it's really tough. If it's just moving by a very small percentage of value, it's really tough to get a good explanation of why it's changing, because it's really, the explanation is this is just a normal fluctuation in account balance year over year. Whereas if you have big changes like 22%, there's usually some kind of a good explanation for what's driving that change. All right, and like I said, the point of these analytical procedures is to help us identify areas of risk. So in an instance like this, if I see their accrued liabilities balance skyrocketing, I'd want to understand why. I'd want to understand what's driving that. So is it that the warranty reserve has skyrocketed because they are having a huge warranty issue, right? Like if think about like an automobile manufacturer who they're having like some huge warranty issue where now they have to recall all these vehicles because there's like an airbag issue. So in that case, you might see something like the warranty reserve skyrocketing. And in this case, it's really not a good sign for the business because it indicates there's a lot of potential future liability out there. Now we also know, hey, warranty reserve is an account with a high risk of material misstatement because we want to look at all the assumptions going into it to make sure that estimate is truly correct, that they're really capturing the amount of potential liability and recording that value. Okay, another analytical procedure you would do is compare accounts that should covary. So there are certain accounts that we expect to see moving together in a normal set of financial statements. So for example, generally revenue, COGS, and gross profit are kind of moving together in the same way, right? Unless they've discovered some magical new way of cost savings or their product, there's huge new demand for it and they can raise the price. Right? Generally, these accounts do move together unless something unusual is happening. So this, we'd expect to see them all changing by about the same percent, right? All changing by around 40%. That looks fairly normal. I mean, it's still looks like very rapid growth to me, but at least the accounts are moving together in a normal way. Compare that to this scenario down here where revenues are increasing by 85%, COGS is only increased by 40%, and their gross profit is skyrocketing. Okay, so again, we'd want to understand what happened here. Is this them trying to overstate their profits? And do they have like potentially false customers in AR, false sales? Or is there a good explanation for this? Like demand for their product has tripled and all of a sudden they're able to double their price and still move a lot of product. We also can look at financial ratios and how they have changed over time to get kind of, again, it's a high level idea of how the company is doing. And that's what you'll notice with analytical procedures. They're really all about determining high level, does this trend or does this account balance pass the smell test, right? Does it look reasonable? Or is there something, does it look like something unusual is going on and this could be impacting my risk of material misstatement and I need to get a good understanding and feel for how that change is happening. So again, when we're looking at financial ratios, a common thing is to look over time. How has a ratio shifted? So something like the AR turnover ratio, how has it changed over the last 5 years? You can also look at the company compared to its competitors in the same industry. If I'm auditing Coca-Cola, how does it compare to Pepsi's? Another thing you can do is compare financial ratios or metrics to non-financial metrics. And that's what's going on here, is we're trying to look at growth in different ways, right? So this is like ITT Tech. You may have seen an infomercial for them during the day or really late at night. So if we look at how their financial metrics are changing over time or growing over time, we see that revenues and total assets are growing by around 16%. So now what you could do is look at non-financial measures, such as how have the number of students changed over time? How have the number of facilities changed over time? How have the number of employees changed over time? And generally, you would expect to see, there might be some things off here or there, but you'd expect to generally see these numbers trending upward or growing at around the same rate. So if their revenues and total assets are changing by around 16%, and then I see, the non-financial measures changing by 16, 17%, this can give me some comfort that these numbers make sense, right? Remember, at the end of the day, it's these financial numbers that I am going to be signing off on, saying they're not materially misstated. So the trigger here is if I see something bizarre going on and the patterns are not matching, that makes me think, maybe financial numbers are materially misstated. And that's what I'm really concerned about, because that's what I need to issue my opinion on. So we have a quick example here of, it's a kind of a fun example of when financial ratios and non-financial ratios did not match up. Okay, so in this example, ITT Tech, the financial and the non-financial metrics did match up. Everything looks hunky-dory, but you could have an example such as this one with Green Mountain Coffee, where these financial and non-financial metrics just simply do not match up. So in this case, we saw revenues and total assets growing by 56, 60%. However, their non-financial measures, specifically pounds of coffee sold, only increased by 25%. So how do you explain this discrepancy between revenue growth and pounds of coffee sold? Well, there could be a legitimate explanation, right? Maybe they doubled their price, but you should be able to tell, particularly if you're like regularly going to the grocery store, that the price of Green Mountain Coffee hasn't doubled. And this is a funny example because there is actually a hedge fund. This guy, David Einhorn, his hedge fund, Greenlight Capital, noticed this and exploited it. What they did was they took a large short position in the stock of Green Mountain Coffee. And then the founder of Greenlight Capital, David Einhorn, went to the popular press and basically talked about this discrepancy, how it made no sense. Like your financial statements make no sense. There are conflicting things in them that make this look like a huge red flag for potential misstatement. And the SEC actually did open an investigation into what was going on here. Green Mountain Coffee had to restate multiple years worth of their financial results. And at least initially, the hedge fund did get richer. They wound up ultimately losing out on this investment, but which is another kind of entertaining long story. But at least initially they did make more money. Like the short position that they took did pay off. All right, so that's analytical procedures. Going back, remember we said there are multiple different types of procedures we can do to assess risk. The first one we talked about was doing inquiries. The second was these analytical procedures. And the third would be observation and inspection. So this can be observing the facilities. This can be inspecting records and documents, reading board meeting minutes. This can be, like I talked about, you do your inventory observations, you go to the warehouses and the distribution centers, and that's where you can make your inquiries of some of these lower level people who are observing the day-to-day operations of the business. You can also take a single transaction and trace it all the way through the process. This is known as a walkthrough because you're walking through the process of the company. So for instance, I'll take a single sales transaction and I'll walk it through as it proceeds through all the various controls of the company, right? I'll make sure it went through that control that the customer had to have credit approved. I'll make sure it went through price checks to make sure we're giving them the correct price. I'll make sure when the goods were shipped out to the customer that it was matched back to the customer's original purchase order, what was shipped. Then I'll make sure when I charge the customer, the prices and amounts on my invoice match up to the purchase order and match up to the shipping documents. Then I'll follow this transaction through the cash collection process, right? I'll see the customer actually paid for the product and the amount that they paid matched the invoice. Then I'll trace that into the company's cash bank statement. I'll make sure the amount on their deposit slip that day matched the amount credited to AR that day. Right? So I'm walking through all these procedures and I'm following a single transaction through this process. And that is known as a walkthrough. And it's really helpful in getting us to understand where all the innate risks lie in a process and what controls are in place to mitigate those risks and whether or not those controls are operating effectively or not.